Let's talk about the 529 to Roth IRA tax loophole that is inside of the Secure Act 2.0. It's Section 126. We talked about it on the last video of the summary version of the Secure Act 2.0, but I wanted to see how we can use this to our advantage. So what is the intent? Let's start with that. The intent that we saw on the summary version was that families and students have concerns about the leftover funds that are trapped in the 529 plans unless they take a non-qualified withdrawal and assume the penalty. So that is, you're going to get a penalty if you take it out early. But I think a lot of people think that this is just, you're going to get the penalty on everything. And that's not true. It's only on the growth portion of the 529 plan. So if you make a contribution to the 529 plan, that contribution, a lot like the Roth IRA, you could take out at any time for any reason without any taxes or penalties because you already paid taxes on it, just like the Roth IRA. Now, if you do not use the money for a qualified expense, in this case, for the most part, college or K through 12 expenses, then it is going to be taxable. But again, only on the growth and as ordinary income. So it's just regular federal income taxes, just like as if you earned income on anything else, plus an additional 10%. So that is what it's trying to avoid, the worry that you're going to have these extra penalties, even though I don't think they're that great in the grand scheme of things. And then at the end, it says they should be able to retain their savings and begin their retirement accounts on a positive note. Now, that's slightly misleading to me because that makes you believe that it's for the parent, and that is not necessarily true. So let's take a look at the actual text, and I'm going to walk you through exactly why that is. So here it says we have to have this account maintained for a 15-year period. They want you to open it up and fund it early, and that makes sense because you have to fund college expenses. They're huge expenses. You need a long time to save, so it makes sense that they put it in at 15 years. Would I have chosen 15 years? Probably something shorter, but in any case, it's 15 years. It's also, you cannot do this conversion from the 529 plan over to the Roth unless you wait 5 years. But what's strange, again, another strange thing, is that it includes the earnings attributable to this account. So technically, if you're really thinking about this logically, you're never going to be able to do that. You're never going to be able to take all of the money out. So let's say you had $5,000 left over and you put it in the day before, who cares? And you waited the 5 years so you can take the money out. Well, it's going to have some growth from last week. So that money's always going to be in there. Why they making you wait 5 years and then the contributions and the earnings makes absolutely no sense. But again, that's what it's saying right here. Now, the next part here is saying is paid into a direct trustee to trustee transfer. And this is where I want to point it out, to a Roth IRA maintained for the benefit of such designated beneficiary. So you open up a 529 college savings plan for your kids. You are the owner. They're the beneficiary. Well, this just told you the Roth IRA maintained for the benefit of such designated beneficiary. So it's not for you, it's for the benefit of the beneficiary. So what does this really mean? This is saying to me that is going to benefit your kids and they can take the money from their 529 college savings plan because they're the beneficiary and they can at some future date put it into their own Roth IRAs. That's fine. But what this is also telling me is that maybe you should open up a 529 college savings plan yourself and put you as the beneficiary because you can. And then if you need to fund your kid's college plan, then you could just take the money from that plan and roll it over to their plan to use for their college. And that means then you have two plans. You could have their plan and your plan. And as money is left over, then you can put it into their respective Roth IRAs. That is what this is looking like. But that takes a little bit of pre-planning because you need to have your accounts open for 15 years. So open it and start to fund them, but with the idea that it's going to be open and funded for you in your name, but it's going to fund your kid's college plan. And at the same time, they can also have their own 529 college savings plan. I don't think that was the intent of what this was trying to do, but if you're reading the text and trying to figure out, hey, I want to save for college, but I also have to save for retirement. How do I do that? And what if there's money left over? Then how do I handle that? I think both of those can be answered by making sure that you have plans for your kids and also one in your own name with you as the beneficiary. Again, you could change the beneficiary at any time. What a lot of people don't even realize is if you think you're going to have kids, and probably most of the people watching this video already have kids that they're saving for, but even if you don't have kids, you can open and fund a 529 plan. And then when you do have kids, just make them the beneficiary of that particular account. Now, there is a gray area here, and that is the maintaining this plan. So it says it right here. So which has been maintained for the 15-year period ending on the date of such distribution. Maintained is kind of an ambiguous term to me, because does that mean that it has to be maintained with the same beneficiary, or could you just have the plan open and change the beneficiary? And hopefully at some future date that will be clarified. But as it stands right now, it would just make sense while we're waiting for that to get kind of worked out, then open up a plan in your name with you as the beneficiary. So that is one way we can get around this stuff. And when it comes time to do this stuff, there are two limits and one non-limit that you need to be aware of. So the first limit is going to be how much can you roll over each year? And that is going to be up to the maximum that you can put into the Roth IRA. So whether or not you make the contribution to the Roth IRA or do the rollover, those numbers will aggregate. So right now it's at $6,500, and you can split that up any way that you want. But what you cannot do is roll over $6,500 and then contribute $6,500. You can only do a total amount of $6,500 and split it up any way you want between contributions and rollovers. In addition to that, you have a lifetime maximum of $35,000. So total, $35,000 is the most that you'd be able to take from the 529 and roll it to the Roth IRA. In addition to that, the non-limit is kind of interesting from a planning perspective, and that is there is no Roth IRA income limits applied to the rollovers. So you can essentially avoid having to do the backdoor Roth strategy and be subject to the potential of the pro rata rule. If you're not familiar with that, I have videos on the pro rata rule and explaining that a little bit further, but this will allow you to do the rollover and not necessarily the backdoor Roth strategy. Now, this isn't going to help you for a ton of years. It only goes up to $35,000, and the Roth IRA limits will continuously increase. So it's likely 2, 3 years, 4 years maximum that you'll be able to do this if you're doing the full amount from a 529 college savings plan rollover to the Roth IRA. So this is an interesting way to potentially supplement in a year or 2 or 3 to the backdoor Roth strategy in lieu of. You can also use this strategy as a legacy plan to think, okay, the 529 makes sense. If I can use these strategies to get some of the money out, maybe I can help my kids get more money into their Roth IRAs early on or a little bit later in their life if their income increases, something along those lines, and funding a 529 college savings plan with a little bit more flexibility. And that's what we've seen over the years. We can do this strategy now. We could pay off student loans up to $10,000 strategy. You can use this for the beneficiaries. So if you have multiple kids, you can start planning for each one of them. There's just a lot of different ways that you can use this to your advantage. And we can also look at what's the biggest one here, saving for college. Now, do I think this is going to really answer the question that they're trying to accomplish? No, because what they're saying is people are hesitant to save for their 529 college savings plan because they have retirement over here. Well, this is only going to help people who've already planned or planned well in advance to make this happen. And it's not even going to be all of the money. And it just doesn't seem that robust to me that it's capped at $35,000 with this idea that they want to incentivize people to start saving. So they didn't address the people that are already in the 529 college savings plans, those parents that are already saving, because yeah, sure, this is going to help them, but will it encourage somebody? I don't know. I don't think so. I don't think it's going to encourage me if I have that far out to think about 15 years from now that I will be able to actually fund my Roth IRA and know this is for my retirement. It's not going to help people who are struggling with that to separate the two. They need to have those two accounts for a reason. And that doesn't get answered here. So let me know in the comments what you think of that. So But in a nutshell, I do think that this could work. I do think that it could help people, but economically, financially well off. That's who it's going to basically cater to, even though in the summary text it says this is for people to get past the idea that they can't save. So I don't think it's going to do that. But I do think that it's a good provision, a step in the right direction. But obviously, I've pointed out some issues that hopefully can get clarified, and maybe some provisions in the future that will actually fix the leaving the and growth portion to it for 5 years. Basically means that you can never empty this thing out completely. So that is the 529 college savings plan to Roth IRA tax loophole. Let me know what you think in the comments down below, and we'll see you on the next one.